Hi there everyone, and thanks for joining the channel and checking out the videos. In this one we will be talking about common things that new loan advisors miss when talking to their clients that ends up resulting in having to decline the loan application. But before we get started guys, please remember to subscribe to the channel, like and share it, and add any other comments in the comment section below for things that may have gotten you to decline a loan application for someone. And first on the list is DTI. So that's because debt to income can have multiple types of examples that can be missed when new loan advisors take on new applications that will result in declining that application. And our first example for that is student loans. So the reason student loans are a common issue is because they report to credit in many cases with zero monthly payment, so new loan advisors won't think to add any of those accounts into our calculation. The correct way is to lump sum all of those student loan balances on credit and multiply it by 1% or 0.5%. And that number we get is basically going to be our monthly payment we need to add and calculate in our DTI. And a quick pro tip to distinguish the 1% and the half of a percent. So with Fannie Mae, you calculate 1% of the total balances that we got for the student loans. And with Freddie Mac and other government mortgage programs, we calculate half of a percent of those balances. And our second example is going to be child support and alimony. Now, the reason why a lot of new loan advisors miss out on this one in their debt to income calculations, it's because it's not reporting to credit. So what we need to do is we need to ask our client if they had a divorce within the last 10 years. And if so, we need to get a divorce decree because that decree is going to show us if they're receiving child support and alimony or they're paying child support or alimony. That way we can determine what debt to income ratio we need to calculate. Our third example is going to be for personal taxes owed to the IRS and or property taxes owed to the county. We need in some cases to account these two in our debt to income ratios. The reason is because some clients owe money to the IRS, so they have a repayment plan with them, so we need to factor that in, or the county has a certain amount of taxes that is due to them and they're going to put it on the title, so we also need to account for that cash flow to go and pay back for those taxes. Hence, it can influence the monthly payment, so we need to figure out our debt to income ratio in regards to that scenario as well. And our second review for things that can sabotage our process is a title. In many cases, what we do is we do a title search. That title search is going to tell us if there's any additional mortgages or liens recorded to title, things like HELOCs, mechanical liens, second mortgages, backed taxes. It can be anything, so it's always important to ask your client, hey, is there anything else recorded on your title besides the main mortgage? And the third item we have is going to be about bankruptcies and foreclosures. Now, bankruptcies are always going to show on credit, so you can always tell based on the discharge or dismissed date how you should go about doing your file as far as the seasoning guidelines go. But foreclosures are not going to show on credit reports. They're going to show on title searches. So unless you have access for that, great. But if not, you want to ask the client if they've gone through a bankruptcy within the last 7 years or foreclosure within the last 10 years. Our fourth review is going to be about cash reserves. So there is a guideline that basically Fannie Mae has set in place that says between 45 and 50% DTI ratio, we're going to need to have the client qualify with cash reserves saved on the side. Now, this could be anything. This could be 401k, savings account, checking account, any account that has cash reserves in it. But if our debt to income calculation lands between 45 and 50%, we will need cash reserves in order to qualify our client. And our fifth subject is going to be about trust. Lots of clients put their estates and other financial accounts in a trust in case of them passing away. Now, the issue here is we need to know if that trust is revocable or irrevocable. Revocable, we can do the loan transaction, we can make changes to the title. Irrevocable, we cannot touch, we cannot do anything with it. The only option is for the client to go to their attorney and have discussion on how they can go about changing that trust to a revocable one and what does that mean to them as well. And this last part is just as important as the other previous ones we talked about, but this is about the condition of the home. Now, the reason I want to bring this up is because if the appraisal report comes back that we need to fix something around the house, the issue that comes along with it is that most clients don't have the capital or the reserves saved in order to fix different things around the house. So we have to talk to the client and figure these things out first. Now, some of the things you want to ask are there any cracks in the foundation or any issues with the foundation? Any issues with the roof, any leakage, holes in the roof, things of that nature, any missing sheetrock or any construction going on in the house, any missing cabinets in the kitchen, any exposed electrical wires, is there a basement, any windows in that basement, any exit door. All of these items can show up on an appraisal report, and we have to make sure that there are no issues with those items. And that's all I have for this video, so thanks again guys for watching. Please remember to subscribe to the channel, share it, like it, and add a comment in the comment section below on different scenarios that you're running into that forced you to decline a file. Again, thanks for watching, and I'll see you on the next one.